Have you ever stopped to think about what might happen if the world's largest economy, long considered the pillar of global stability, started to falter? The US dollar, which for decades has been the backbone of the global economy, is now facing one of its most serious crises in modern history. This is not just an abstract concern for economists or investors. It has real implications for everyday Americans, global markets, and the financial systems of almost every country. Cracks in America's economic armor are becoming increasingly visible. The U.S. job market, once the strongest pillar of the economy, is showing signs of strain. In August, only 22,000 new jobs were created, falling far short of expectations. In June, 13,000 jobs were actually lost. Meanwhile, the unemployment rate has risen to 4.5%, and inflation remains stubbornly high. Economic growth is barely moving, painting a worrying picture of what experts call stagflation, a dangerous combination of slow growth, rising unemployment, and persistent inflation. Stagflation is particularly perilous because traditional policy tools often fail to provide relief. Cutting interest rates may not stimulate growth as expected, while raising rates to curb inflation can slow an already stagnant economy. This isn't confined to one sector. Manufacturing, technology, finance, and even government jobs are all feeling the pressure. Companies are tightening belts, laying off workers, and delaying expansion plans, creating ripple effects across communities that depend on these industries. Much of this traces back to the trade policies and tariffs introduced during the Trump administration. While intended to protect domestic industries, these measures had unintended consequences. By making imports more expensive, production costs for manufacturers increased. Companies that once thrived on international supply chains suddenly faced higher expenses and reduced profit margins, leaving many with no choice but to cut jobs or slow hiring. The cumulative effect is being felt across the economy today. At the same time, the dollar itself is showing signs of weakness. For decades, it has been the most reliable currency, the go-to safe haven in times of uncertainty. But that perception is shifting, and this has serious implications not just for the U.S., but for the global economy. The dollar's strength historically allowed the U.S. to borrow at low costs and finance deficits easily. If trust in the dollar erodes further, borrowing costs rise, inflation could spike, and managing fiscal responsibilities becomes far more challenging. The Federal Reserve now bears the responsibility to stabilize the situation. Their upcoming meeting on the 17th is widely expected to result in a rate cut. Historically, delayed or insufficient action by the Fed has often failed to prevent recessions. While a rate cut could provide temporary relief to borrowers and businesses, it also carries risks. Lower interest rates tend to weaken the dollar, which could accelerate its ongoing decline. This year alone, the dollar has already dropped nearly 10%, and last week, the dollar index fell by 0.7%. A weaker dollar undermines confidence in U.S. Treasury bonds, prompting foreign investors to pull back and leaving America to shoulder more of its own debt. That, in turn, risks fueling even higher inflation. As the dollar's influence wanes, global attention is shifting toward alternative stores of value, especially gold. Foreign central banks now hold more gold than U.S. Treasury bonds, a situation not seen since 1996. Gold prices have surged to $3,650 per ounce, and analysts, including Goldman Sachs, predict prices could reach $5,000 per ounce in the coming years. Even a small shift of just 1% from private holdings in U.S. Treasury bonds to gold could create upward pressure on prices, signaling a profound change in the global financial landscape. This trend reflects a broader global shift. China, Russia, and India have already begun reducing reliance on the dollar, and BRICS nations are increasingly conducting trade in local currencies. Gold now constitutes 30% of their foreign reserves, while the share of U.S. Treasury bonds has dropped to 25%. Historically, during crises, investors fled to the dollar and U.S. bonds as safe havens. Today, bond yields are unstable, confidence in the dollar is weakening, and gold is emerging as the new refuge. These trends were underscored at the recent BRICS virtual summit in Brazil. Brazilian President Luiz Inácio Lula da Silva criticized ongoing trade restrictions and high tariffs imposed by the U.S. and other Western countries, noting that such measures disproportionately affect emerging economies. He emphasized the need for stronger regional trade networks and alternative financial systems to allow these economies to protect their industrial and export capacities. Indian Prime Minister Narendra Modi echoed this sentiment, arguing that tying trade to political or strategic disputes only increases inequality and distrust. Chinese President Xi Jinping highlighted the need for multilateral cooperation, calling on BRICS countries to work together to navigate the current global economic framework. Indian Foreign Minister S. Jaishankar also stressed that international trade cannot operate solely under the terms of the most powerful nations. He highlighted that the global trading system must be open, fair, transparent, and inclusive, giving developing countries the flexibility and support needed to account for their unique economic realities. Together, these statements signal a fundamental shift in the global economic order. Emerging economies no longer see themselves as passive participants in a dollar-dominated system. They want a voice in shaping the rules that govern global trade and finance. This points to the rise of a multipolar economic world, where influence and financial power are no longer concentrated solely in Washington, London, or New York. For the U.S., the implications could be profound. An aggressive Fed rate cut could weaken the dollar further, destabilizing bond markets as foreign demand drops and yields become unpredictable. At the same time, global power dynamics are shifting. Asia and BRICS nations are gaining influence, while gold and local currencies are emerging as alternative centers of financial strength. What was once a symbol of certainty is now a source of uncertainty, and investors, governments, and ordinary citizens are all watching closely to see what comes next. The questions are clear. Will the decline of the US dollar reshape the global financial system in the coming years? Will gold truly become the new center of economic power, or can America stabilize the dollar and reclaim its position at the top of the global financial hierarchy? These are not theoretical questions. They are decisions that will influence jobs, investments, and standards of living worldwide. The coming months will be a test of American policy, corporate resilience, and global adaptability. The Federal Reserve's moves, business strategies, and the responses of other major economies will determine whether the dollar retains its central role or whether the world shifts toward a more multipolar, diversified, and potentially more volatile financial order. What is certain is that we are witnessing a historic moment. Traditional assumptions about economic power and stability are being questioned, and new dynamics are emerging that could redefine the rules of global finance for generations.